Welcome to Wealth Alchemy, the channel where everyday knowledge turns into golden opportunities. Today, we're diving into a hot topic. The U.S. Federal Reserve is signaling possible interest rate cuts in Q3 of 2025. But what does that actually mean for your money? Whether you're holding cash, thinking of buying a home, investing in stocks, or curious about gold and crypto, this video is your guide to protecting and growing your wealth as interest rates shift. Section 1. Why Fed rate cuts matter to you. When the Fed cuts interest rates, borrowing becomes cheaper. That helps businesses and consumers spend more, which can boost the economy. But for everyday people like us, it also changes the value of cash, the cost of housing, and the behavior of markets. You might be wondering, should I invest more now? Should I hold cash? Will prices go up or down? Let's break it all down, one step at a time. Sections 2, cash, is it still safe? Let's start with cash. In a low interest rate environment, the money in your savings account earns less, sometimes barely anything. That means while your money sits still, inflation quietly eats away its value. The smart move here is to avoid holding too much idle cash. Keep just enough for emergencies, maybe 3 to 6 months of your basic expenses. The rest can be moved into low-risk, short-term investments like treasury bills or money market funds. They offer better returns without locking you in for years. Section 3, real estate. Is it time to buy or hold? If you're thinking about buying a home, lower interest rates can be a blessing. Mortgage rates tend to drop, which means your monthly payments become more affordable. But don't rush in just because rates fall. Make sure you're buying for the right reason, not just because everyone else is doing it. If you already own a home, you're likely in a good position. For property investors, be extra cautious. Rates may be lower, but over-leveraging during uncertain economic times is still risky. Section 4. Your job. Invest in yourself first. Here's the truth. Rate cuts may help businesses borrow more easily, but that doesn't guarantee job security. The economy could still slow down. That's why the best investment you can make right now is in yourself. Learn new skills, explore side hustles, strengthen your earning power, whether it's learning digital marketing, coding, content creation, or even financial literacy. Skill growth gives you stability in an unstable economy. Section 5. Stocks. Opportunity with caution. Stock markets often love rate cuts, especially growth stocks like tech companies. That's because lower rates reduce borrowing costs and make future profits look more attractive. But don't jump into the stock market blindly. If you're new to investing, consider starting with broad market ETFs like the S&P 500 or the NASDAQ 100. They spread your risk and track the market over time. And remember, don't invest money you'll need in the next few months. Stock markets can go up and down, so stay consistent and think long-term. Section 6. Gold. The timeless hedge. Gold has been a store of value for thousands of years, and for good reason. When rates fall and the dollar weakens, gold often rises. It doesn't pay dividends or interest, but it protects your purchasing power. A modest amount of gold, physical or digital, can act as a hedge against inflation and currency risk. You don't need to go all in, but having some exposure can bring balance to your portfolio. Section 7. Crypto. Risk and reward. And then there's crypto. Bitcoin and Ethereum have shown strong rallies during loose monetary policies in the past. Why? Because rate cuts often mean more liquidity in the system, and risk assets like crypto tend to benefit from that. But make no mistake, crypto is high risk. If you believe in its long-term value, you can consider small, regular investments using a dollar-cost averaging strategy. Just make sure it's money you're comfortable taking risks with, and don't bet the farm. Section 8. So what should you do now? Here's the big picture. With interest rates potentially going down, now is not the time to sit on the sidelines. It's time to take action. Smart, measured action. Keep enough cash for emergencies, but not too much. If you need a home, lower rates might help. But stay within your means. Invest in yourself. That's your best inflation-proof asset. Build a long-term stock portfolio and stay consistent. Add some gold for balance. If you believe in digital assets, dip your toes, carefully. Wealth isn't built by reacting to headlines. It's built by preparing before the headlines hit. If you're watching this, you're already ahead of the crowd. If this video helped you think differently about money, give it a thumbs up. Subscribe for more content on wealth, investing, and navigating the economy with confidence. And let me know in the comments, what's your biggest concern right now? Cash losing value, stock volatility, or missing out? I'll see you in the next video, where we'll explore the best beginner ETFs for 2025 and beyond. Until then, stay smart, stay safe, and stay invested.